In this third clip on currency exchange, we'll be looking at a couple of issues that have public policy implications. The first of them really has to do with one of the drivers behind the development of the European currency, or the euro, and that has to do with exchange rate risk. When you have trade among countries, especially in a small geographic area like Europe, the ability for trade to take place across borders is hampered if each different country has a different currency, and thus an exchange rate. And here's an example. Let's imagine that a French winery wants wine bottles in order to bottle their wine, and they find a good German bottle making company, and they work out a deal. They agree on a price for a shipment of bottles that will come from Germany to France. And when they agree on that price, they obviously are thinking in if this is before the euro, they're thinking in two different currencies. The French are thinking in terms of francs, and the Germans are thinking in terms of Deutschmarks. At the simplest point, that what they'll do is agree on a price, assuming the current exchange rate between francs and Deutschmarks. However, as often takes place in business, the contract is made on let's say day one, and the delivery may happen several weeks later, let's say 30 days later. And then once the delivery is made, invoice is cut, and typically the actual payment isn't made for another 30 days after that. So it's possible for there to be as much as 60 days from when the price was set on the bottles and when the actual payment takes place. Well, in today's world of fast-moving currencies and global exchanges, 60 days is a long time, and the value of a currency can change quite a bit. If that exchange rate does change between French francs and German Deutschmarks, somebody's going to get hurt. Somebody's going to either pay too much in value or receive too little in value. Now, there are ways that parties can hedge against this, but ultimately it makes this form of trade more expensive, less likely to happen. It doesn't prevent it entirely. It just adds to the cost and the risk of actually making that trade. So this is one of the driving forces behind the formation of the European currency. By removing these differences between France and Germany, it meant now that trade between those two countries could continue with less resistance. There's also today, especially in times of economic uncertainty and slow growth, countries are very concerned about exports, and a country that wants to have more exports, which would increase their gross domestic product, the best way they can do that is to encourage, or at least enjoy, a decrease in the value of their own currency. If that happens, if their own currency, like let's say the United States dollar, drops in value against other major currencies around the world, then goods made in the United States appear to be cheaper than to the foreign buyers. And the foreign buyers are then more likely to be willing to buy the American U.S. made goods. So a decline in the value of the U.S. dollar actually encourages more exports, and that's good certainly for the countries for the industries within our country that do exports. There's a downside to this, of course, and that means that imports, things that we buy overseas and bring into the United States, now cost more money to us. If the value of the U.S. dollar goes down, then items made overseas and imported into the United States are more expensive. And so that's a problem for other parts of our market. A continuing major issue on the world currency scene is China and its continued insistence on managing the value of its currency, the renminbi, also sometimes known as the yuan. And China has very specifically bought other currencies and taken other steps to keep the value of their currency quite low. Now, you'll recall from an earlier clip that if you export more and more goods, that should raise the value of your currency. And certainly China has been exporting lots of goods. And in a normal fluctuating, free floating exchange rate, we should expect to see the Chinese value go up and the value of their currency go up. But instead, they've managed to keep it low. That means that the value or the price of their exports to big purchasing countries like the United States stays low. And that's a big concern, both politically and economically, for manufacturers and other producers here in the United States who need to compete against China.